Hello, my name's Ben Radclyffe. I'm the Commercial Director for BitMEX, one of the world's largest cryptocurrency derivatives trading exchanges. Today I'm going to talk a little bit about market makers, what they do, who they are, how they came to be, a little bit about some of their strategies, both in the traditional markets and then how they roll over into the cryptocurrency trading world. Also going to touch upon some of the things that I think probably need to be in place to help the industry grow and the segment grow, introduce more of the traditional market makers into the cryptocurrency trading world, which should improve things for everybody. Okay, so what is market making? There's a lot of content to squeeze into a 30-minute or so presentation. So I'll try and take some questions at the end, if possible. And if people do have extra things that they want to ask me, please feel free to get in contact. I've got some contact details at the end that people are very welcome to hit me up on. Okay, so market making. The idea behind market making and market makers is that in any market, obviously there's buyers and there's sellers. The problem is that they don't always want to buy and sell, firstly at the same price, but also at the same time. Often in a market, people want to buy and there's no sellers, and vice versa, people want to sell and there's no buyers. Back in the olden days, what would happen is traders and brokers would be wandering around the coffee shops of London and Amsterdam, trying to buy and sell their shares, and they'd wander into the coffee shop of choice expecting to find it full of people with the opposite side of the trade, and lo and behold, no one's there. So quite quickly the gap in the market was filled by people who were quite happy to speculate that they would be able to buy some shares from somebody at a low price and then sell them back to somebody else a little bit later for a much higher price. They put their own capital on the line. They take the risk that something might happen to the price of those shares during the time that they were holding on to them. But generally, if you did it enough and you had a good feel for the market, you could make a little bit of money. Fast forward into the modern age, you're not walking around the streets of London anymore. You're probably trading on an electronic marketplace, or in the case of the New York Stock Exchange, up until reasonably recently, you'd be standing in a big room full of other people. You'd have a jacket on, and your role would be to provide liquidity and make markets in a particular stock. You were a specialist. You had a particular role to play. If somebody wanted to buy and sell something, they would know who to go to. They'd go to the guy who was the specialist in that particular stock. As a market maker, what your role was, you'd have maybe a chalkboard sitting behind you, and you write up your prices, a buy price and a sell price. Probably a very large difference between those two numbers. Again, really denominated in quarters or eighths or sixteenths of a dollar. And you sit there and make markets all day and take the spread between the two prices. I've got some examples here as to how that might work. So this first example, obviously a bit of an exaggeration, but we only have sellers. We've got a seller there at 105 looking to sell 10 shares, and a seller at 110 also looking to sell 10 shares. No problems if you're a buyer who wants to buy a small amount, but if you're a seller or a buyer who wants to buy maybe 100,000 shares, then you better see if that coffee shop owner will let you stay overnight. The other problem with illiquidity, of course, is that maybe 105 isn't the right price. Maybe this thing normally trades at 10 or 15. You can't tell. Okay, so no one wants to trade in a market like that. So one of two things happen. One, a bunch of market makers, again, professional people with their own capital, skilled traders often. They see a gap in the market. They think that they can go and make some money. They would turn up and start making markets. Sometimes that doesn't happen. Sometimes the exchange realizes that they have an issue with some of their books and some of their markets, and they're actually incentivized to try and encourage market makers to come into the market in various ways, which we'll get to later. Okay, so I've updated the example. I've got a single market maker in there. It's one guy, again, sitting in his little coffee shop in London. He's got maybe a little blackboard behind him, and the price is now, he's coming as the buyer. He's going to be able to buy your stock for 90. He's willing to buy 10, however much that is, and he's willing to buy another 10 at 80. You've still got your original seller there trying to sell their 10 shares at 105, and the market maker is also there at 110 for an additional 10 as well. So if you have a look at this, a much healthier market. There's the original seller is still there trying to sell their stock at 105 at their original price, but the market maker is now turned up and is starting to provide prices on both sides of that market. They're pretty wide. Maybe the real price of this instrument, maybe it's 100. So the market maker is trying to buy at 90 and hopefully sell at 110. If they can, they would end up making a 20 currency of choice profit every time they bought and sold, which for the market maker is great. And for everybody else, previously there were no buyers and now there's some buyers. You might have to pay a little premium or lose some premium when you transact with the market maker, but at least you can get your trading done. Okay, so how can you make that better? So example number 3, what I've done is I've added in some competition for market makers. So as you start to introduce competition of market makers into the market, you'll see that the first thing that happens is that the spreads start to reduce as they compete with each other. If you're not the top of the queue with the best price, then it's very unlikely that anyone's going to buy and sell from you. And then once the spread reduces to the smallest spread that you can get, so you can't compete on spread, the queue lengths start to grow quite substantially. So you end up with this situation where there's now a really tight spread and lots of liquidity available. All the other market participants are super happy. They can turn up. They look at the chalkboard and suddenly they can sell at 100. They can buy at 101, and it's not 10 shares anymore. It's 100 shares. These market makers are really starting to add some liquidity into the market. The other good thing that happens is that now there's some price discovery that goes on. So just by if you look at the first example, there's no buyers, there's only sellers. You're not really sure what the price is. In the third example, there's lots of liquidity there. There's a big long queue. You can get 100 shares done at 101. You get the feeling that the price is probably somewhere between 100 and 101. You can go and you can transact 100 shares without changing the price. And really that's the definition of a healthy liquid market. Obviously it's a bit more complicated than that. We'll come on to some examples later on, but the concept is there. The market makers add their capital to the market. They start providing prices that previously weren't available, and then the normal traders and investors and brokers and other market participants can use them to buy and sell with when other buyers and sellers aren't there. Okay, so I've mentioned liquidity there a couple of times. I thought it'd be useful to talk a little bit about what I mean by that. Everybody always says, I need liquid markets, liquidity is king, go to the most liquid market you can find, so on and so forth. But what is it they mean by that? Very basic, simple definition of liquidity is the ease at which an asset can be bought or sold without impacting the price. So if you think about that, let's take traditional stock market. I want to go and buy one share of Apple. Am I likely to change the price of Apple by buying one share of it at market? Probably not. I want to go and buy one Bitcoin. Am I going to be able to change the price of Bitcoin by buying one Bitcoin? Probably not. If I wanted to go and buy $500 million worth of Bitcoin in one go, am I going to be able to do that? I'm probably going to start having some impact on the price. So really what you're looking at to determine whether a stock is liquid or not, or an instrument is liquid or not, you're looking at, okay, how wide is the price, the spread at the top of the book to start with, and how many shares are posted near the top of the book. Thought it'd be useful to show you some examples. So I've got a video here from the BitMEX testnet site on the left, which doesn't have a huge amount of liquidity in it. It's being used for testing purposes, obviously, so there's a few bots there. As you can see, the prices are updating, but what's top of the spread's pretty small. The spread's still quite narrow, but as you can see, if I wanted to go on there and buy even $100,000 worth or 100,000 contracts, I'd probably have a bit of price impact there. Certainly if I was going to go and buy 1 million, the book would, the price of the book would definitely move. Now compare that to the screen from production. The XBT USD swap product is incredibly liquid, as you can see. So if I'm going to go on there and buy 100,000 contracts of Bitcoin, it's probably not going to have any impact at all on the price. Clearly, depending on the time of day, what's happening to price in the market at the time, that will affect how confident people are putting their capital up and trying to predict what the price is going to do in a short amount of time. So, some of the things that go into the decision-making processes around for market makers about how much capital they're willing to commit to an exchange or to a particular instrument, they're looking at a very simple equation. The lower the risk to them, the more capital that they're willing to deploy, right? Especially if the returns are going to be reasonably high. And if you think about that, it's fairly obvious. They're making their money from buying on one side of the spread, selling on the other side of the spread. The more they can do that, the more money that they're going to go and make. However, as we'll see in a second with some of the examples, if an instrument is moving around a lot, it's got unpredictable price movements, especially directional ones, the market maker can stand to lose money instead of make it. They'll also be looking at things like the stability of the system that they're trading with. You don't want to find yourself in a situation where you place an order to an exchange and there's a technical problem. You can't cancel your orders, you can't amend them, you can't update them quickly, you can't change your prices. Maybe you get a trade done and you don't find out about it on the market data feeds. There's latency in the systems. Maybe your counterparty isn't trusted. All of these different things add up to be a decent measure of risk, and the higher the risk, the lower the capital, and therefore the lower the liquidity that the market maker is able to provide to that market. So, in summary, a deep liquid book can absorb more buyers and sellers before the price needs to move. Okay, so certainly one of my roles is to encourage depth of book and liquidity onto the exchange, because we think it's better for all participants. Okay, a little bit of history. So far we've spoken mainly about guys in coffee shops with chalkboards. Clearly that's not how the market works anymore. I mentioned the guys with the funny jackets standing on the floor of the New York Stock Exchange as well. But it wasn't always like that. So if you wind back the clocks, and not even that far to be honest, kind of to the sort of mid-80s, the vast majority of trading was done on the stock market floor, like physically. There was phones involved, there was people running around with pieces of paper. The market makers themselves, or the specialists, were front and center there, and they were able to make their markets. Again, the prices and the tick sizes back then were measured in fractions of dollars. Can you believe? And they were therefore, the smallest spread that you could get was sort of 6.5 cents or 6.25 cents, or 1/16 of a dollar eventually. Okay, so they're running around. They're taking their orders. Some institutional clients, some pension funds, some hedge funds, some retail customers, some private money, so on. The market's buzzing, and then suddenly Black Monday happens. It's 1987. The market begins to crash rapidly, and those market makers, and in fact the whole floor of the New York Stock Exchange and stock exchanges around the country and around the world, start to overload. Everyone gets very, very, very busy. Now at the same time, mums and dads at the same time, the retail investors at the same time as the institutional investors. Everybody's trying to sell their stock all at the same time. It's a huge market crash. So if I'm mum and dad, or my granddad, for example, phoning up his broker, can't get through on the phones. The capacity's taken. You know why? Because the broker's talking to his more important client or his larger customer, maybe the pension fund, trying to sell their stock first. It goes on all day, and eventually the phones and the trading floor closes, and all the retail customers are left not having sold anything. So what happens in reaction to that is the regulators in the United States decide that actually these retail mums and dads need a way of being able to do their share trading as well without having brokers standing in the way. They pass a law or a regulation that requires the specialists on the floor to automatically fill at the bid or the offer any share or any order that comes in electronically into the exchange, predominantly aimed at retail customers, so those retail customers can close their positions without having to sit in a queue and run the risk of not being able to sell their stock, like happened in 1987. So the markets have gone electronic. The market makers are sitting there; they're still updating their chalkboards with their chalk, buys and sells every so often. Update, and their clerks are sitting there, on their computer screens, updating, making sure that the prices are reflected in the computer system. Now, very quickly, some people worked out that if they were to get themselves one of these terminals for the stock exchange, and they knew what they were doing, they could pick off the market maker's stale pricing. Let's say the market maker starts eating a sandwich, or maybe they pop off for a cigarette break. Those prices aren't updated, and the professional trader armed with a stock exchange terminal can very quickly cause them to lose money. The reaction from the market makers to this was obviously to find out a better way of updating their prices constantly, so they weren't picked off for stale prices. So maybe they started automating some things. They brought the first computers onto the stock exchange floors. They plugged their computers with their very basic programming into the stock exchange computer, so that at least their prices were roughly updated in real time. Suddenly, the guys on the other end of that, with their armed with their new terminals, they found it much harder to make money. The prices weren't stale for long enough for them to be able to pick off those market makers. So what they did is they invested also into some computer hardware and automated their processes. So what you had was this arms race between market makers on one side, trying to keep their prices updated as quickly as they can so they weren't stale. And on the other side, you had these professional traders armed with terminals and their computer systems, trying to identify prices that were slow and obviously incorrect, and take advantage of them. The arms race continued for a few years, as you can imagine, with one side of the market and the other side of the market just getting quicker and quicker and quicker, trying to pick each other off. So what this ended up doing was effectively, moving the market very quickly from a very slow, very manual process, where spreads needed to be fairly wide, because the traders could only trade, a small number of stocks, a small handful of stocks manually, using their chalk. Very quickly, that became computer-driven. Now, one of the great things about computers, obviously, is that they can do things at scale that humans can't. So suddenly you had market makers that were able to make markets in hundreds and hundreds of stocks instead of just a small few. Those hundreds and hundreds of stocks obviously had competition in them as well, and as we saw from the previous example, what happens with competition is the spreads start to narrow very quickly. Around the same time, the stock market changed from a fraction system, so the 1/16 of a dollar spreads, and went to a decimal system. So the smallest spread that you could now get on the majority of these stocks was a penny. So you've gone from 6 and a bit pennies to 1 penny, so much narrower, much tighter spread, at the same time as the computers were able to be very aggressive in their market making across many stocks. And obviously the competition between market makers kicked in, and the spreads collapsed, and quite quickly you ended up with very tight spreads across many stocks all at the same time. What this caused was a huge kick up in the amount of activity that was going on. The market makers were able to buy and sell much more. The electronic trading takers were able to trade much more. And as you can see from the graph here, the volumes on the stock exchange, this is the S&P 500 trading volume in millions of dollars a day. It's gone from a long-term average of essentially $0 million a day on that chart. You go through electronification, it starts to ramp up very quickly. You've got decimalization in there as well, providing another kicker. And then finally, as you can see from the chart, there's an enormous vertical spike there when the third big piece of regulation change comes in, and that is not competition between market makers, but actually competition between markets themselves. Now, suddenly market makers and their electronic trading competitors were able to trade not just on one particular market, but across many markets, the same instruments. And the regulation that came in said that actually you have to do that if a market who is a member of the SIP provides a price that is better than the price you can get somewhere else, you're by regulation required to go to that exchange to do your trading. So as you can imagine, the market makers are trying to make markets across many stocks now. The amount of capital that they have to deploy goes up. The amount of trading that they do goes up, and they are, the good ones at least, manage the risk very well, and the profits for these electronic market makers go up very steadily as well, to the point, and their volumes to the point where some of these market makers and some of these electronic trading firms are very large percentages of the overall trading that's done on the markets. Up to, I think the latest estimates are sort of 50-60% of all trading that occurs in the US, and actually many other stock markets are similar, is done by this group of people. Okay, so I thought I'd come up with an example just to really highlight what these guys are doing and what's important to them. This first one you can do yourself. Go on to GitHub, download an exchange or a cryptocurrency exchange library of your choice, and start listening to market data. And every time the book changes, simply post at the bid and at the offer. Okay, so you want to buy something at the bid and sell something at the offer, and do that all day, and you'll make loads of money. Under one very specific circumstance, and that's that the book never ever changes price. It's an excellent strategy with only two small problems. The first problem is that typically the costs of doing that, the fees that you pay to the exchange, will be greater than the amount of money that you'll make from doing that trade. And the second problem is, if it was profitable, then everyone would be doing it, and the queue would be enormous. So you would be at the back of that queue with your Python script, unfortunately, because being at the front of the queue means that you're much more likely to be the person that does the trade. So a couple of things in there, quite interesting to look at. First one is costs, hugely important, as you can imagine. If you're doing many trades and you're trying to make a very small amount every time you trade, the costs of doing those trades have become hugely important. So rates are very important for market makers. The second issue that I raised is the speed at which you can put your orders onto the exchange is incredibly important as well. If you're at the back of the queue, it's very unlikely that you're going to get a fill unless it's a bad one. So it's very difficult to make money if you're slow. Okay, so let's work through that example. You're buying at the bid, you're selling at the offer. In an ideal world, the market would just go up and down between the bid and the offer, and you'll make some money. Typically what happens though is you'll manage to buy some at the bid, then you'll sell some at the offer, and then you'll buy some at the bid, and the price of the market will go down really quickly. So maybe you're 10 or 15 spreads lower than you were hoping to be, and you end up having to sell your inventory effectively at a loss. So you've created a loss-making machine, as you can see from my loss-making machine. I'm currently losing P&L there. Not very surprising. If it was that easy, everyone would be doing it. So how can we improve? One way that you can improve is you're trying to guess when the market is going to go in one particular direction, a bad direction for you, and you try and close your positions out as quickly as possible. So let's take the same example. I buy at the bid, I sell at the offer, I buy at the bid, and then it looks like the market's gonna go down in price. I quickly cross the spread, I close my position out, I don't make any money on that position, but then when the market drops another 5 or 6 spreads, I haven't lost any money, which is really where the skill comes in. Great, a much bigger improvement to my strategy. Things that I can look at, I need to effectively come up with a machine that guesses accurately which way the book is going to move in a short amount of time. I can look at things like order imbalance. So is the queue on the bid really small and getting smaller versus the queue on the offer that's getting really big? Maybe the price is going to go down. I can look at order intensity and trade intensity. Maybe lots and lots of trades are happening on one particular side of the book, and I can maybe infer something from that as well, especially compared to historical averages or what I would expect to happen. Other lead indicators, maybe what I'm doing, instead of looking just at the market that I'm trading, maybe I can look, let's say I'm trading a Bitcoin index. Maybe I can create something that looks at the makeup of that index and try and move my prices around before as the index moves. Perhaps I'm trading an instrument that trades elsewhere, identical, so maybe Bitcoin on one exchange versus Bitcoin on another exchange, and I've worked out that every time Bitcoin moves on the exchange over here, the same thing happens on the exchange over here very quickly afterwards. So I can use that as a signal. Maybe there's some correlated instruments. Maybe if I'm trading Bitcoin dollar, I can look at what the dollar's doing. I can look at what maybe Ethereum's doing. I can look at a basket of cryptocurrencies. Perhaps there's some signals in there that I can use as well. The mathematical models that go into these things are obviously, firstly, extremely complicated, and secondly, extremely proprietary. So they're guarded, heavily guarded secrets a lot of the time. As they're literally the bread and butter of the firms that have invented them. One thing that I'll talk about now is the need for being fast. Okay, so while these models are proprietary, many people are trying to do something similar to you, effectively get to the top of that book. So you need to be the fastest. Okay, that takes us down the latency rabbit hole, as I call it. So I've got an example on the page here. We're going to run a very simple strategy. The strategy is I'm going to look at exchange number 1, and every time the price moves, I'm going to update my price on exchange number 2 because I think that exchange number 1 is a leading indicator. And if I can do that faster than everybody else, then I stand to make some money. So I'm sitting there with my mouse and I've got my web page open. And I'm waiting for the price to change, and the price changes, and I click the amend button and I update my price on exchange number 2, and brilliant, my market making strategy is working really well now. I've got this magic signal that always works. Unfortunately, somebody else has worked it out, and they're now just a little bit faster than me because I'm manually looking at these things, and perhaps I blinked or I yawned, or I wasn't watching properly. I was watching YouTube videos, so I'm not quite as good as I could be. So I'm going to update my system. Simple way, I'm going to automate it. Okay, so I'm going to put a computer in the way. Now instead of a person sitting there clicking a website, I've got a computer watching market data feeds and doing exactly the same thing for me. Brilliant, right? I'm now much faster than all the people that are manually clicking buttons, and now I'm making money again. Unfortunately, the competition, they've worked out the same trick. They've worked out how to code their market making strategy as well, and they've got maybe a better computer than me. Okay, now I need to think of a better thing to do. So what else can I do to improve my system? I can upgrade my computer. or I can shorten the amount of time that it takes for signals between those exchanges to come to my computer. Perhaps I can rent some space nearby where these exchanges are running. Perhaps I can upgrade my network so that it's a bit faster. Perhaps I can work out a better route across some telco lines to get to the exchange faster. So I can see those price moves now quicker than the competition can. Brilliant, right, I'm back up and running, I'm making money again. Unfortunately, the competition managed to find a way of shortening those distances even more. So I'm now unprofitable. So I go down and sit down with my engineers and I work out that perhaps what I can do is I can shorten that distance entirely, and I can put my computer in the same data center that the exchange is running on, and in certain cases on the same computers or the same computer network that the exchange is running on. So now I'm super fast. No one can be faster than me getting that signal from exchange number 1 and sending my trading signal across to exchange number 2, and I'm back up and profitable again. Okay, unfortunately, there's still a network between exchange number 1 and exchange number 2. And my network is a copper piece of cable that goes, you know, under the road and around the corner and in up a wall and into the building where exchange number 2 works. And my competitor has worked out a better way of doing it. So my reaction to that is, okay, what's quicker than going down a cable that snakes around the world? Okay, I'm going to use microwave signals. I'm going to put a microwave transmitter on the top of my my building where exchange number 1 works. I'm going to point it at exchange number 2, and I'm going to go in a direct line, which is as quick as you can get, to exchange number 2, and I'm back up and running again. Fantastic. My signal is getting to exchange number 2 even faster than my competition. Okay. Obviously the competition works that out, and now I'm being beaten again. Okay, so I've done my network, I've done my co-location, and I upgraded my computer, but maybe I can do a better job at that. So let's have a look. Maybe I can upgrade, I can get a better network card, I can do like kernel bypassing in my operating system, I can write my own operating system, I can use bespoke C++ compilers, I can get a tuned algo written by some brilliant algo developers, and I can really squeeze the most out of this trading algo that I've got. I'm back ahead of my competition again. Unfortunately, they hire some better people and spend more money on their hardware, and now I'm losing again. I'm coming in second and third. What do I do now? I know. I'm going to throw my computer in the bin, and I'm going to get my trading algo, and I'm going to burn it into a piece of hardware specifically designed for running algos. So I've got my FPGA cards or my ASICs chips. So I'm now back up and running the fastest again, and so on and so forth. All right, and this essentially this battle, this arms race goes on and on and on and on and on continually all the time inside these market-making trading firms, because being first is so valuable, so much more valuable than being second. Okay, so we talked a little bit about some of the risks that market makers face that may cause them to not trade as much or not commit as much capital to a market. One of those risks was volatility, and volatility a lot of the times is caused by illiquidity on a book for some reason. Now the danger for a market maker is when they're trading in unpredictable markets, they tend to lose money rather than make money. The only problem with that is that when you have illiquid, volatile markets, what you really need is more market makers. So you end up with this sort of chicken and egg scenario. So let's say I'm a market maker, I'm trading in an illiquid and volatile market, and I'm losing, say, a basis point every time I do a trade. I don't really want to be involved in that market because I'm essentially losing money all of the time, but the exchange really wants me involved. Perhaps it's a new product launch, it's an ETF that's just listed, it's something where they're trying to encourage market makers to build a deep and liquid book to attract more traders into that market for whatever reason it happens to be. Now, as a market maker, I'm losing that basis point. What the exchange can do is take some of the profit that they're expecting to make from having this product trade on their market and share some of it with me. So let's say I'm currently losing a basis point every time I trade. The exchange, instead of charging me a fee, may choose to give me 2 basis points. So now I'm doing the same trading. I'm losing a basis point because I'm trading in a liquid and volatile market, but I'm being given 2 basis points by the exchange for doing so. The exchange is being paid maybe 5 basis points by the traders on the other side, so it's essentially a profit split. It's great for the market makers because they get paid for taking the risk on. It's great for the exchanges because they have products that are now deeper and more liquid, and it's great for the traders on the other side because they're able to interact with the market that has much more depth and liquidity in it. Some of the other ways, I've just talked about what's essentially what's called a maker-taker pricing model, where the maker is paid and the taker pays, and the exchange takes a spread in the middle. There's other ways of incentivizing market makers, lower fees just for trading volume. You can have maybe a stipend, and what that means is that you're paying the market maker, essentially you're writing them a check. Please make markets, or here's some money. You can do potentially a profit share. You can give them technology allowances. So if you make markets for me and you do a good job of it, I'll give you some extra exchange connections for your other trading businesses. Or I won't charge you as much money as I would have done for your market data, for example. So some financial reward for providing the service of liquidity provision. In return for this, sometimes it's not as simple as just making markets, because that can mean a lot of different things. If you make a market and it's 20% wide instead of 1 basis point wide, you're still really making a market, but it's not that useful to anybody. So often what will happen is the exchange and the market maker will enter into an agreement that has some statistics or some parameters around which the market maker is required to provide that liquidity. So things like, a good example might be if you provide a 1-tick spread for $1 million of stock for 95% of the time that my market is open, and you trade more than $5 million a day, then I will give you a rebate of 2 cents per share that you trade, for example. Lots of different exchanges around the world in the traditional markets run market making incentive schemes. Some of them are available to everybody, some of them are only available to a set of designated market makers. Some of them you have to be a member of the exchange in order to participate in. But there's lots of different varieties and lots of different flavors, but they all have some impact on what the book looks like. So one of the effects of incentives is, let's imagine that you're a market maker and you're currently trading. I've got some example books here. You're a market maker. You're currently trading a market, and you're buying at 90. You're selling at 110. The exchange comes to you and says, I'm going to pay you 1 basis point for every trade that you do as a market maker. I can now narrow my spread. So I could make it 91 and 104, or 109, sorry, and continue to make exactly the same amount of money as I did beforehand. One thing to note on that is that as a market maker, I'm trying to enter into as many profitable trades as I possibly can, and maybe at the 90 and 105, there may be 10 profitable trades a day. At 91 and 104, maybe there's 100 profitable trades a day, because they're happening much closer to that spread. So that additional amount of money that the exchange is paying the market maker to tighten their spreads up actually increases volume non-linearly, which again is great for the exchange, great for the market maker, and also great for the other participants, as there's more depth and liquidity available to them. I wanted to finish off just by talking about another couple of complexities that exist in the cryptocurrency market for market makers, and in fact for many other market participants as well, but one that's particularly acute for market makers. And that's the fact that cryptocurrency markets are typically pre-trade checked and pre-trade cleared. What that means is, in order to sell something, you need to already have it sitting in your account at the exchange, and in order to buy something, you already need to have capital sitting in your account on the market as well. What that means is that your capital is locked up whether you're using it for a position or not. Now, in a traditional market, brokers, central clearing counterparties, and exchanges themselves who net out trades and provide certain carve-outs to market makers to allow them to do things like naked short sell and increase the liquidity that's available on the market without the market maker needing to hold inventory. Those things don't exist yet en masse in the cryptocurrency markets. So what that means is the market makers have to actually physically deploy their capital to the exchanges that they're trading on. So a quick example of that might be, I'm a market maker, I have $1 million, I post that $1 million to BitMEX, say. I'm trading on BitMEX, I've got $1 million worth of capital. If I now also want to go and trade on a different cryptocurrency exchange at the same time, I either need to find another $1 million so I can do the same trading there, or I need to take $500,000 of my $1 million on BitMEX, move it to the second exchange and trade a smaller amount at the same time. So what the industry is trying to solve for is allowing for that capital to move around exchanges much faster and allow these market makers to trade more and provide more liquidity without being constrained by the capital being stuck in one particular location. Okay, so that brings us to the end. I've managed to do 40 minutes of presenting at home without being interrupted once by the kids, which is pretty impressive. And I've certainly got a newfound respect for YouTubers out of doing this process. Hopefully next time we'll be able to do a live presentation and meet some of the people that are listening today. Quick summary of what we've talked about today. Market making's been around since the early days of exchanges. The capital that they bring to the market and the service they provide can help increase liquidity and price discovery for everybody. The lower the risks in the particular market, the more capital that they can commit, which is, again, that leads directly to increased liquidity in deeper books. It's an incredibly competitive space, as we've seen in the chase for lower and lower latencies. But if you can create a fair and level marketplace, that competition will just continue to be fostered and will bear out in, again, more liquidity and better spreads, less volatility for products. Finally, that capital that they do commit needs to be as efficient as possible. Not only are there many cryptocurrency exchanges competing against each other for the limited capital that market makers do have, but we're also starting to compete, or have been competing, with the traditional markets as well, as many of these market makers are professional firms that have been around in the equities and futures markets globally for many years. So hopefully one of the knock-on effects of all this additional liquidity, better price discovery, lower volatility, is that some of the participants that haven't yet become involved in trading in cryptocurrency markets, perhaps because the positions that they need to take are too big for the market to absorb without causing undue impact, can start getting more involved, can start doing their beginning trades, and bringing more participants into the crypto trading world will be great for everybody. So with that, I'll leave you to it, and hopefully I'll get some questions on the live chat in a second. I'll do my best to answer them, and I hope to see you all again at the next conference, hopefully face to face next time. Thanks a lot for listening and for your time. See you soon. Bye.